Have you ever wanted to invest in the S&P 500, but you didn't want to lose your principal? This new ETF by BlackRock says that they can protect 100% of the downside risk while still giving you exposure to the S&P 500. Let's jump in and take a look at this new ETF and see if those claims are true. All right, welcome back to the channel, everybody. So today I wanted to go over a new fund from BlackRock, the iShares. This is a pretty interesting new concept. I just saw it and kind of want to go over it. So it's called the MAXJ, it's the iShares Large Cap Max Buffer June ETF. So what it does is it caps the upright, or it tracks the S&P 500 and it caps the upside. I believe it's 10.5, and it protects the downside up to, it says 100% on it. So over here on the investment objective, the fund seeks to track the share price return of the iShares Core S&P 500 ETF, which is the IVV, up to an approximate upside limit, while seeking to maximize the downside protection against price declines of the underlying ETF over an approximate 1-year period beginning at the end of each June. The current period is July 1, 2024 to June 30, 2025. Now, this fund came out on July 1st, so it hasn't been around for very long, so we don't have a lot of information. What it does is it's going to be using options on it, so it buys the funds and then it buys put options and it sells call options. So I went over the perspective and just kind of want to go over, take a look, highlighted a couple of things. So let's see here as we come through. It looks like they have a couple other ones. I didn't look too much into what those were, but it's so on the hedging and the upside or the downside protection, it's over a 12-month period. So in the prospectus, it says if you don't hold it, or if you buy it before or after, you may not have that same protection. I think that's just probably legal jargon. Or if it drops down, maybe it averages out. Because it would be pretty hard, I guess, to buy it exactly on that day. So the fees is 0.5 on the management fee, which is fine. You know, it's a higher fee, but paying a higher fee for something that's in theory difficult to do, which would be hedging your downside risk, or buffing against the downside risk, is something that I'd be willing to pay for. Let's see here as we come through. The portfolio turnover. This is true for most any ETFs, I think. A higher portfolio turnover rate for the fund or underlying fund may indicate higher transaction costs. The fund seeks to provide exposure to the share price return of the underlying ETF up to an approximate upside limit. The upside limit is 10%, 10.5%, I believe. And to maximize downside protection against the underlying ETF. Let's see. So the nice thing about this one versus, like say, JEPEQ, is that it actually owns the underlying ETF and then uses options with that, versus those funds only use options. Let's see. So it uses what they call flex options. When I looked at flex options, it just means that they're not normal options. They can be, they can kind of create their own options and write their own rules on them. So let's see. Let's keep going down here. Yeah. So there's no guarantee that the approximate buffer will succeed and provided the intended protection. Yeah, so here it says the fund will buy the underlying ETF and futures on the underlying ETF's index and seek to enter into the combination of option transactions described above if there are any inflows or creation transactions during the hedge period. So if you get a bunch of inflows, they'll use futures and options to offset that. Anytime you're doing options, there's always a chance that they not work, or they not work as they're supposed to if there's some kind of black swan event or something that they weren't anticipating. So here it is. The appropriate buffer and approximate cap for a hedge period only apply to the fund shares held over the entire hedge period. So this is over an entire year from, let's see, I think they said the hedge period. I thought I saw that it was in March, but in the earlier one they said it was June. So here's the other part. An investor that purchases the fund shares after the beginning of the hedge period or sells fund shares before the end of the hedge period may not fully realize the approximate buffer or approximate cap for the hedge period and may be exposed to greater risk of loss and less potential gain. So basically, if you don't buy it exactly on that day, they're saying that you run the risk. Here's the other part that was a bit interesting. In the period of extreme market volatility, the fund's returns may be subject to upside limits significantly below the appropriate cap. So you may not actually get 10% or 10.5%, and the downside protection is significantly lower than the appropriate buffer. So you may lose more than 0.5%. I think they said it's 100% buffer, but with fund fee coming out, it would be 0.5%. So, but yeah, it seems like it's a pretty interesting fund. If we look at the iShares Core S&P 500, the year-to-date return is at 16.73. So your return, if it had been going for the entire year, would be capped at the 10%. 1 year is not as good because it's at 24%. You'd be capped at 10%. I think that this would be an interesting fund, and curious on what other people think. But I think it'd be interesting fun if you're using it. Maybe you're partially retired or getting close to retirement. You wanted to limit your downside exposure, or maybe if you're just coming into the market and you weren't really sure. I may park some money in it, like an emergency fund. I don't know if I would park a lot in it because it's an untested ETF. It's an untested theory, so it may not work like they say as they expect it to. But yeah, parking maybe some funds in it from like an emergency fund, so you get a little higher potential upside, and your downside is allegedly buffed. But, tell me what you think. Are you going to be planning on buying this in this ETF, or is it, how do you think that people should be using this? And how do you think that their strategy will go? It's a new ETF, just came out on I believe it launched on the 1st. Right now it's 4th of July of 2024. It came out on July 1st of 2024. But yeah, leave a comment. Tell me how you think, and have a great rest of your day.